Okay, so today we're going to get into SR and basically how to isolate the turning points in the market using support and resistance. And this is really important to me because support and resistance links everything that I do. Okay, every single entry that I take in a trade, other than my gap trades, which is just based on the gap, that's about the only thing that's different, has support resistance level as an entry. Now, some might have confluence. Sometimes the fib level lines up with an SR level, great, etc., etc. Other factors of confluence can come in, but every single trade has a level in it as a basis. So it's really important. I never take a trade unless it's got a level in it for the entry. So it's really important that we isolate these turning points. Now, I use SR to kind of map the markets. And it's one of my key foundations. Now, today, I don't want to talk too much about strategy today. Exactly how you play them is something that we're going to get into perhaps in a later webinar. It's kind of what the thread's about as well, exactly how where we play these levels. But we use them to kind of make a map of the market, a roadmap that we can follow. One of the key foundations, okay, in terms of strategy and how these levels work and how these levels play out is that, as most of you guys and girls know, when the market breaks a level, it usually tests it from the other side. So if you've got a big support level in the market and that support level is broken, that level is then very likely to become resistance. If you've got a big resistance level and the market's broken, that level is then likely to become support. So the levels flip, and that's one of the key foundations of how I trade. Now, let me just pull up PaintShop Pro for a second. I'll show you something. Okay. So what we have in the marketplace is we can have areas that are just support. Okay. And when we're drawing our levels, we look for these as well. So there might be areas that have just been decent support. And of course, the flip side of that is we can have single areas that might just be resistance. Okay. So the price might have come into them, traded off them, and they can be just resistance. Then we can have levels that are both. Okay, so it can have been prior resistance, the market broke through it, became support. This is what we know as the support resistance flip. Now, when we're drawing our levels, it's important we look at all three, because some people just look for flip points. But we have to look at all three, and the reason that we look at these two as well, and we have to mark out these two, is because although they haven't flipped yet, we mark them in anticipation that if price moves through them, price will flip. So we've kind of got three different scenarios, three different types of level that we can look for. Single support, single resistance, and the flip point. Now, one of the things that I just quickly wanted to go through before we go any further with that, and most of you probably already know this, but just something that I think is useful for those of you that don't. When I mark a level on, I use the weekly, the daily, and the hourly. And I color code them differently in my own personal trading. So I use red for weekly, orange for daily, green for hourly. Kind of got like a traffic light combination going on there. So I know that red, that's the high time frame of the weekly. The big areas on the chart. And we come down to the daily, orange, and then the hourly, right down the thick of the action is green. Now, one of the things I do is when I draw a level on, let's just say I put a level here, okay, and this would be, since I'm on a weekly chart, I'm going to mark this out in red. Now, one of the things I do is I right-click on the level, go to horizontal line properties, and I make sure that on the visualization tab, okay, I untick show on all time frames and tick everything up to weekly. Okay, so everything's marked. So I see that on all time frames below weekly, but not above. Now, when this gets important is, for example, when you put an hourly level on. If you stick an hourly level on the charts, okay, so I'll just stick an hourly level here. When I put an hourly level, I don't want that, which it is at the moment, showing on a weekly chart. It's just going to confuse me. Because we have quite a lot of levels, we're going to have hundreds of different levels. When we look at a weekly chart, there'll be so many levels, we can't see the price action. So on an hourly chart, again, I want to right-click, horizontal line properties, visualization, and just tick everything up to hourly. Okay, that then enables me to not see that level on a weekly chart. Okay, and I can only see it on an hourly. So on an hourly, I'll see hourlies, dailies, and weeklies. On a daily, I'll see dailies and weeklies. On a weekly, I'll just see weeklies. If that makes sense. And I found that it just makes the charts a little bit easier to read. The other thing is, again, I apologize if most of you know this, but one of the easiest things to do is once you've drawn your level, okay, once you've actually drawn your level, you can double click on it. Once you put those properties in, double click, hold down Control, and you can drag another level out of that level. Right, so this second level's got those same properties. So you can just keep throwing levels, all around the charts like this, but they've all got these same properties. Okay, that's just very basic MetaTrader stuff for you. Hopefully everyone knows that already. But, just in case you don't, I'll throw it out there. Now, the other thing I wanted to just say as an introduction before we start actually getting into the nitty-gritty of how we place these bad boys, what we want to actually think about is lots and lots of people say, right, I've got too many levels on my charts. I got 80 different levels. I'm getting really confused in. And the conventional wisdom that people say is, well, only put the best levels in. Okay, only just put the best levels in. If I put the best levels in, I don't get confused by loads of other levels. And it's one of those things in trading that sounds great in theory, but it's really, really difficult in practice because it's not so much the entry that's the problem. It's the management of trades, right? It's always the management of trades that's the hardest part of trading. And the problem is, if you only isolate the best levels and you say take an entry, let's say you look at a weekly chart and you think, well, I've got a great level here, let's say a great level there, and I've got a great level down here. These are perhaps the best levels on a weekly chart that's close to price. But if you get long at this one and you've got no other levels in between, then you've got to ride it up there. How do you map the market to manage your trade? It's quite difficult. So I think if you don't have loads on, then you risk putting more in once you're in the trade. And then obviously once you're in the trade and the money's moving, your P&L's moving up and down, you kind of get a bit biased. So what I like to do is I like to mark out all the areas, but I know that I'm not going to trade off of all of them. I'm able to visualize which ones are great trading opportunities and which ones are going to be used to just map how the market's moving or perhaps take profits on shorts or longs that I'm in. And like I say, this is the hard element because really what you need to be good at doing is having a lot of levels on your chart, but knowing instinctively which ones you would trade at. Like I say, if you've only got a few of the absolute best, it does make life a little bit more difficult. So let's look at one of the first things before we get into drawing levels. Let's look at what actually makes a level good. Okay, what actually makes a level a decent level that we can trade. And there's four things. Okay, and you might want to take a note of this. There's four things that make a level decent. And the things that I look for. Now, the first one is the number of touches. I'll put N touches. The number of touches it's got. The more touches, the more formidable that level is. So we like the greater number of touches, the better. Those are the areas that I'm instinctively drawn towards on the charts. They make excellent levels. The second time is really important. Obviously, it stands to reason that if you've had a level that's been in play for a year, as you know, a year of support that we're about to break is a lot more important to the marketplace than a week of support that we're about to break. The longer that's been building up and the more number of touches it's had, the more significant it's becoming. The third thing that's really important is the violence, okay, excuse my handwriting here, so I'm writing with a mouse, the violence of the reactions of a level. Okay, what you're looking for, ideally, with your trades, or with your levels, I should say, is you're looking for the market to have swung from them, to have made some really decent reactions. The more violent the reactions away from these levels, the better they become as levels. So again, if you've got a market that in the active session has been dipping into a support and flying up 100 pips and then coming back and flying up another 100 pips, it's a lot more reliable as a level than if, for example, you get a little overnight level in the low liquidity Asian session where you're perhaps getting just 5-10 pip reactions off of it. It's much more significant. Much more significant. Now, the other thing, finally, number 4, that's important is the recency. Okay, now this is where a lot of people make mistakes. If I know how to spell recency. Okay. Did I do a degree in English literature? I think that's right. Okay, anyway, recency is really, really important. Now, one of the mistakes I see people make a lot in drawing these levels is they tend to focus on the left of the chart and then work towards the right, which makes sense in a way because that's how your eye reads. But what I found is that a lot of the pro traders that are drawing levels and that I was watching start at the right and work to the left. So they start at the most recent price action and work back towards the left. Now, the reason for that is because market participants always tend to put more emphasis on what's happening recently than what was happening. You know, if you think about it, what happened yesterday, the day before, is more important in a way to the market than what happened 3 years ago, because traders are constantly jostling for positions around these levels. So we like to try and focus on the right and work back towards the left. And these 4 things are the things that we've constantly got in our mind when we're drawing these levels. So number of touches, the time that's elapsed, the violence of the reactions, and the recency. With all of these points are linked by the fact that more is better. Okay? More touches is better, more time is better, more violence is better, more recently is better. Okay? So we have those points in the back of our minds. Now, there is also something else that I would just quickly throw in at this point here, and that is that, and I'll bring a chart up now. We've got the dollar Swiss here that I'm looking at on the weekly. We'll start off with this one. What I look at, and this is quite subtle, but one of the things that I bear in mind with levels is when I'm placing them, because I'm really keen, as people that read the thread know, I'm really keen on buying the inverse or selling the inverse. So when I like to buy a level, I like to buy what was prior resistance, and I also like to sell what was prior support. Now, I think that bias affects me a little bit when I'm drawing levels. So what I kind of like to do is, if I'm drawing levels below the market, I like to just tweak them a little bit so they're perhaps slightly more biased to resistance than support. Okay, and I'll show you all this in a minute. And again, when my levels are above the market, I like to tweak them a little bit so they're more biased to support than resistance. So it's kind of which side of the market am I drawing the levels on that's going to make a little bit of a difference to what I'm doing and exactly where I'm drawing them. Now, what we're going to do now is we're going to get into actually just marking up some charts. Now, the way we'll do this, I'll go through this dollar Swiss and the weekly, daily, and hourly. We can pull up more charts as well and go through them. And then towards the end of the session, we can have, like I say, the last half an hour, we can have Q&A, and we can talk about different elements of this in more detail. What I do, and it's a completely blank chart, obviously. What I do is I start out on the weekly time frame. Now, the importance of the weekly time frame is really as a zoom tool. Okay, so let me say that again. It's important as a zoom tool because these levels are always, to an extent, zones. Now, what I mean by that is it's very, very hard to find an absolute line in the sand. Now, don't worry, because we are going to find it. That's the whole aim of this webinar. We're going to find the line in the sand, the level you trade at. But we've got to be aware that we are placing that level within a zone. You know, not support, previous highs, previous lows. They're not going to line up picture perfect. So we're always trying to find a level within a zone. And on the weekly, if you think about it, it's a bit harder to do because the weekly is a higher time frame, which means the zones are going to be a little bit wider, and it's going to be hard to finesse as well. So I never ever trade off a weekly level because I'm a touch trader. So I need to get that bang on the turning point, minimal drawdown. So the weekly, what I want to do is I want to mark out the big areas, and I don't want many. I just want the big areas that immediately leap out to me. And it's really on the daily and the hourly that I'm going to spend the time getting to grips with exactly where I'm going to put the level. Now, the first thing that you can do on a weekly time frame is you can just look at where we are. And again, one of the questions I get quite regularly is how far above do we start drawing levels all the way up here? Looks like there's a level up here. Do we draw that? I would say that when you're getting to grips with practicing these levels and drawing these levels, and even if you're actively trading them, I would say you don't need to mark up your entire chart, because the dollar Swiss is not going up to 132 anytime soon. You've got plenty of time to mark in levels up there. So I would usually concentrate, and I think it's a better exercise to concentrate on about approximately 500 to 600 pips above and below market with your levels, because those are the levels that price in the next 2 or 3 weeks is likely to be interacting with. So those are the ones you really want to define. I know some people that spend hours trying to pinpoint the exact level. That's about 3,000 pips away from price. Is probably not going to reach it, for the next 2 years. So we'll look at the recent price action. Okay, so let's get into the nitty gritty of it. If you look here, the dollar Swiss weekly, what we're going to do is we're going to start marking out the turning points that we can see. Now, one of the first that I notice, and what I'm doing here is I'm starting at the recent price, and I'm looking at swing highs and recent swing highs and swing lows, and I tend to work in a solid direction, which is up from down to up. So I'm kind of moving up from the bottom of the chart here, seeing any levels that are in play. Now, the first one that's kind of striking me here is this thing here. Okay, I'm just going to mark it in red. Okay, so what we've got here is a pretty clean flip. We've got nice support, these bar lows, and that flip to then resistance here and resistance there. Now, exactly where you draw the level, this is what the webinar is about. Exactly where you draw the level is down, obviously, to the individual, and I doubt that everyone's going to be getting it in exactly the same place as me. But again, with our focus on the points that we looked at, one of the things that we like is the number of touches. So if I've got a level, if we actually zoom right in here to illustrate the point, if we've got a level and we can see that here, okay, it didn't quite hit it, did it? That candle there didn't quite make its way to the level. And these candles here didn't quite make their way to the level either. But what we're doing is we're trying to put a level in an area of the mean, okay, the mean of the zone, and at a point which has the most touches. Now that takes a little bit of time to get your head around it, but this is the foundation of kind of what I do when I'm drawing these levels. I'm trying to isolate the zone with my eye. So here, the zone is basically why are we even drawing the level in this point? It's because obviously there was solid support here that flipped to resistance there and resistance there. It's basically this area here, that area there. Now what I'm doing is I'm drawing, if you know where I've drawn my level, it's in the mean of those two zones. It's a little bit above this, but it's a little bit below that, but it also lines up with 2 touches. So it's in the mean with a couple of touches. So that would be my first level. Now if we move up from here, we'll see a second level above market, right around here. Now again, this is another point I wanted to say, some markets are much easier to draw levels on than others. Dollar Swiss, for example, is a bit of a dream. That's why I started with it. You get into something like US dollar Canadian, and it becomes approximately a nightmare. You can draw levels, but it's much harder, and you spend a lot longer doing them. But the dollar Swiss is very clean. But you see again here, very, very basic flip point. You've got decent support, decent resistance, decent support. Again, what's good about this is the number of touches. You can draw a level at a point where there has been multiple touches. So not only does it mark out basically the entire, it encapsulates the entire support resistance line, but you've got zone, but you've got all the touches in one place. Now, when we move up from here, this is where it gets a little bit trickier, because people start seeing, this is why it's important to work from right to left, because people will notice this, okay? They'll notice this here, and they'll say, oh, I've got to have a level there. Now, I wouldn't place a level there. Part of the reason why I wouldn't place a level there is I know we've had single bar touches here, and we've had a single bar touch there, a single bar touch here, but I think that on a weekly chart it looks a little bit messy. I'm not really interested in single touches unless there's been a lot of them, and again, it's been relatively recent. So here, I mean, I personally wouldn't put that level in. Now, the interesting thing is that when we get down onto a daily time frame, we're probably going to find that we've got a level there. In fact, I know we've got a level very near today, so I was trying to buy it Friday afternoon. But on a weekly chart, I wouldn't personally put that in. But on a daily, we're going to see it when we drop down there. So move up on the weekly, we keep going, and the level now. Oops, just put that back where it was. The next level that I would spot on the weekly is going to be here. Now, why here? Again, let's zoom in and have a look. What we've got, again, it's very obvious. We've got decent support here, decent support there, flip to resistance, flip to support, flip to resistance. What I like about this level is, again, look at the recency. It's recently acted as resistance, and before it did that, on the week before last, before it did that, it was decently acting as support. So it's a nice little flip point. And again, a pretty clean one as well. Now, when we start moving higher here, you start coming up to areas like this, and people will put in areas like that. Now, I don't think that's a great level. Personally, a lot of people will like that. Why? Because they always put so much emphasis on the left-hand side of the chart. So they'll go, oh, recent swing high, recent low point over here, and it's a great level. Like I say, I probably wouldn't mark that. Now, again, what's interesting about this particular chart is when you drop to the daily, we're going to have a level there. Because again, you're about to see, there's a level there, but it's prominent on a daily time frame to me. On a weekly, there's just way too much time that the market's traded in and out of this and ignored it. And I don't like that. So to me, that's not going to be a level. These points are very, very clean. On the weekly, I just want the cleanest. You can be a little bit more, on the daily, it's a little bit different. But on the weekly, I just want the cleanest. And like I say, really, that's because I don't like the weekly time frame because the zones are so wide. So they've got to be pinpoint on the weekly. So now what we're going to do is we're going to drop to the daily. We're going to see what the picture looks like on the daily charts. Now, obviously our weekly levels are showing up, which is cool. So we're now going to go through and see what we've got on a daily time frame to draw these levels in. Now, first things first, what I like on this daily time frame, one of the first things I'm noticing is, again, moving from the bottom up towards the top. There's something that the first kind of thing I'm actually noticing. Some of you might be noticing stuff down here, but the first thing I'm noticing is this. I'm just going to draw it orange. Now, let's look at this closely. Why do we have a blue line? The blue line is where the current price is, I think. Let me take it off, just because it's going to confuse us. It's a light slate grey. We'll take it off. Okay, that's where the current price is. Can get a little bit confusing. Is that what you meant? Okay, cool. Yeah, MetaTrader just puts a line on where we are at the moment. Now, if we look at this, some people are just going to slap this level here and go, right, okay, yeah, that's fine. Support here, resistance there, yeah, support here. It looks pretty good, right, where it is. What I would do here is I'll move this a little bit lower because I want to pinpoint the exact point, okay? So, in the area is not really good enough for me. I need to pinpoint the exact turning point. When you're a levels trader, it's critical. Now, if you think back to what I said at the beginning about I try and slightly bias it towards, if the market is above where we are, I'm going to slightly bias it towards what was resistance last. Okay, so if we move this level down a fraction to there, you see you're basically, it hasn't made a whole lot of difference, has it? We're still in the zone, but you see how I've geared it towards these last 3 bar highs. Now, by moving it down, it really hasn't made any difference. If we zoom out, we've caught all the turning points. Basically, support, resistance, support, resistance. What difference does it make if it's there or there? It looks identical. But the difference is is that price tends to gravitate towards resistance last. So I will bias my level in favour of that. And if any of you guys have followed me on Twitter, you'll know that that was the level I was harping on about Friday afternoon, 89.05, 89.04. Because it's in the zone, but it's slightly biased towards that point last. You missed the point, Fabio? Oh, it screwed up the sound a little bit. What I was just saying is that ordinarily you just go ahead and you slap a level in on the charts. So you put a level in like that, and we can see that it's basically been support. Okay, so some of you are confused. Okay, fine. Let's look at this in a little bit more detail. Basically, if we all know that we're drawing levels at flip points, right? So we can just draw a level right in there. Okay, that's where the majority of people are going to trade it, are going to place it, because it's the flip point. We can see there's a bit of support, bit of resistance, bit of support, support, resistance, resistance, support, support. Okay, the 89.20s, 89.50s, it's all around that area. There's a nice little zone. And some people won't take it any further than that. They'll just bang it there and they'll go, right, that's fine. Now, what I will try to do is I will try to gear it a little bit more to prior resistance if we're above, if the market is above where we are, because markets tend to find their way to resistance points, prior resistance points in a big sell-off. So what I would be looking for here is if we move it down a fraction, you see how I'm putting a little bit more emphasis on this minor resistance here. It's still in the same zone. The zone hasn't changed. You know, it's hardly made a difference. You probably wouldn't have even noticed if I'd have said that. I'm just gearing it slightly lower weighting it slightly towards more resistance. If we're above, you know, if I'm drawing levels above market, I'm kind of gearing it slightly towards what was support last. Now, let's move on and look at the next level above that. Well, the next level above that is going to be pretty obvious. It's going to be this, isn't it? Okay. Now, a lot of people, again, are going to draw it here. Now, you might think, oh, you know, if I start moving up 5, 10 ticks, you're going to think, wow, you're being really anal here. But I have to be, because I want to get my levels absolutely pinpoint accurate. Now, if we look at it here, this is enough to place it here at 90.68 for most people. They're gonna see that and they're gonna say, yeah, support, resistance, resistance, absolutely fine. If I put it a little bit higher at 90.81s, or that bar low there, 90.82s, 90.81s, if I put it there, note how it's geared towards the support a little bit more. Look at the number of touches that it's had as support, but it's also focusing again on the recency. You know, so it's focused on the most recent price action. If we dip down to the hourly there, look how it makes all the difference where you place your level. You place it at the most recent area of support, you get the turning point. You place it lower down, you get you place it down there, okay, at the lower level. Okay, so two traders, right? One puts it here and thinks, yeah, that's fine, and one puts it there. Not a massive. It looks like nothing on the daily chart. And when you come down to the hourly, though, look, there's one of them gets the turning point, or maybe just misses it a fraction. The other one sits offside for a few hours, and all this makes a huge amount of difference in your psychology. You don't want to underestimate what a difference this makes in your trading, because even a level that's that close, look at the difference. I know that this one slightly misses. I actually had it a little bit lower, but I know this one slightly misses. But imagine it didn't. Imagine it actually filled it despite the pip higher. The difference in those two trades there is when you're on an hourly time frame and you short the first level, you basically got 4 hours with the trade going sideways and then spiking against you. Short this one up here, you've got absolutely no drawdown. Price just collapses immediately. So it's not only good for getting the turning point, but also quite good for your psychology. So that's where I place the daily there. Then we've obviously got our weekly in play up here, and that's fine. And then I would go above, and the next one that draws my eye up here is going to be this. Now let's focus on this a little bit more. Now, what you're going to notice here, this is quite a tough one, because you've got highs here and highs there. You've got lows, lows, and all these lows across here. But where exactly do you draw the level? You know, most people are probably going to draw it up there. Now, if you draw it up there, again, it looks more or less fine. It looks fine to draw it up there. But if you see, and this is again a really subtle point, I appreciate this. If you see that at the moment we're below that level, now as we trade up into that level, what I'm trying to do is look across and gear it slightly down to what was support last across that line. Now, if I move it slightly down, I capture the last swing high and I capture a lot of the support back here. Which is what I want to do really, is capture significant support when I'm below market. Now let me go off on a tangent for a second and say, people ask often, how often do we update these levels? I usually update my levels once a week. I leave my levels in play for the entire week and I update them on a Sunday. In fact, it's around this time I start doing them for the week, so I'm prepared for the week ahead. Now, if we shot up through that level, okay, and we went parabolic through that level, I'm going to redraw that level, and I'm going to redraw it to there. Why? Because then we need to focus a little bit more. It's still in the same area. We're going to focus a little bit more because this area is going to then have been sizable resistance last. It's quite a subtle point, this, but it's something that figures in my level drawing a lot. I mean, a lot of, again, going off on a bit of a tangent, I've always just drawn levels, and I suppose having years and years of practice, they've just got better and better and better. But when I started recently kind of doing one-to-one mentoring, I was getting loads of questions on my levels and people saying, you know, why did you draw it here? Why did you draw it there? And a lot of the time I just didn't know the answer. I was like, I don't exactly know why I'm drawing it here. That's where it jumps out at me. And you find that a lot of levels traders sort of say the same thing. They just whack it there, and it just instantly appeals to them, but they don't always know quite the answer why. So in a way, by actively kind of teaching people over the last say 6-12 months, I've actually come to break down what I'm actually doing here, and I know that subconsciously I'm putting more of an impact on prior support when I'm below market. Now, there's some good questions here, actually. Do I choose levels by eye only, or do I look at high-low price values? No, I tend to do them just by eye. And on the hourlies, I'm not really going to refine the daily levels, but I'm going to put in new hourly levels. And Hugh, your question, do I clear the charts every week and redraw? No, I don't actually. I just rejig the levels that I've got currently in play. Sometimes you'll find that levels have been completely washed and the market is ignoring them, and then I will delete them. But I'll tend to just rejig the levels that I've actually got in play already. So at the moment, our charts, kind of my dollar Swiss chart, is going to be shaken up like this. Okay, it's going to be looking pretty much like that. Now, again, the reason why the reason why you want to get accurate with these, I'll give you a little story here, which is 100% true. There was a guy in my trading room. Some of you basically, he sat in my trading room for about 6 months, and I basically trade. I don't trade all levels. You know, I trade if the market sets up right. We get an S&P at a level, or we get a nice breakout rounded retest. Those are the trades I take. But one day, this guy, after being in my room for 6 months, he suddenly said to me, right, I'm leaving the room, don't want to come in there anymore, can you just send me your templates? You know, I'll pay your room subscription, can you just send me your templates every week? And I was like, yeah, but why do you want my templates? Like, you don't know how I'm going to trade the levels. So, you know, why do you want the templates? Why are they useful to you? And he was like, yeah, don't worry about that. Just give me a few months of your templates and I'll let you know. And I was like, all right, fine. So I sent him my templates of my levels, and I sent them to him every week. And he sent me his account statements after several months had elapsed. And what he was basically doing is he was trading every single orange level that that I've got on the charts, just the orange daily levels. He was trading every single one with a 20 pip stop, 20 pip target, and he had a phenomenal strike rate. And it was something, funnily enough, that I've never even noticed myself, because I'm picky with my levels. I won't trade every single level on my charts. I'm pretty picky. But he was just trading all the dailies, with literally a 20 pip stop, 20 pip target. And he'd noticed from being in the room for this amount of time how price was clearly, reacting off of them. So there's many ways to trade these things. And one of the things that I would say to people is that you always want to kind of find your own way of doing things. But the other thing is, a lot of people say to me, what about, can I send you my levels and will you grade them for me? If I send you a chart with my levels marked up, will you let me know if I'm doing it right? And I'm always happy to do that, but I would say that the best teacher out there is going to be the market. What you should find on any given week, you get to the end of the week, you've drawn your levels on a Sunday, the trading week goes past, you get to the end of the week on Friday, you should have found that 80% of your levels have prices reacted off. If prices just blitzing through your levels left, right, and centre, you're doing it wrong. 100% you're doing it wrong. I'm not always saying you're going to get a massive 100 pip reaction off of your levels, but if price isn't at least stopping at your levels and going sideways, or price isn't rallying hard off your levels, the majority of them, 80% of them, you're definitely drawing them wrong. So, because they really are extremely effective in marking out the turning points. So the market's your best teacher. Draw levels on and start looking intraday at the end of the week at how price is reacting to these areas. So we've got our dailies here, we've got our weeklies. Now I don't think we need to go any further than that, because we've got, we've covered 600 pips above market and we're covered about 700 pips below market. So I think we're pretty much covered there, but certainly for what we're going to see in the foreseeable future. Now we're going to come down and we're going to finally mark in the hourlies. Now, the hourlies, again, I don't really finesse the dailies. I keep them where they are. What I want to do on the hourlies is hourly time frames. I just want to mark out prominent H1 levels. Okay, so what I'm going to do here is I'm going to mark out all the H1 levels that I think are important and are having a kind of impact on the market. Now, the first one is going to be this here. Okay, so I'm going to mark that in green. Now, again, what you can see here is I'm only picking really the best. I'm picking nice areas of highs that flip to lows, that flip to highs. These are obvious support resistance points, but the skill is in where you actually place the levels. And like I say, what I try to do is get the level in the mean of the zone with the most touches. That's quite key to me if I can find that. So here, I would just move it down a fraction, a little fraction. Why? Because I'm still in the mean, but I've got a lot of touches, a lot of perfect touches across here. But it's still in the mean of that zone. I'm not going to worry about, again, people will be drawing levels all over the place. You get people saying, there's a level down here, a couple of bar lows, yeah, that looks good there. I'm not going to worry so much about that, because that's covered by this daily. This whole area is covered by the daily. If you put too many in, like I say, you will end up with paralysis analysis. You'll end up with levels every 5 pips. But what I'm doing is just marking out, like I say, the key ones to me. Now, sometimes it helps. One of the tools that I use, funny enough, with MetaTrader the most is the zoom tool. Zooming in, zooming out, because you get sometimes you get a good reference for where price is by zooming in and out, and how effective a level is over time. So it's quite a nice little thing to do, to constantly be using that zoom tool and see what's going on. Now, at the moment, as this chart stands, I think we've got a lot of the key points. We've got all the major turning points in terms of how I mark up a chart. But as I was saying at the beginning, it helps to have a lot more levels on there, okay, that you're not necessarily going to trade, but you're going to be aware of. There's another one up here, actually. Okay, again, a very clean point. Very, very nice and clean. You'll often find this on dollar Swiss. It's a very obvious little area. Now, if we move up a little bit above that, we're going to find this here. Okay, a nice flip between support and resistance. Now here, if you look at it, you're going to say, well, if we actually zoom in and have a look at that, you're going to say, well, that was a bit choppy. You know, price went through it a bit there. Again, it's never going to be a perfect thing, but I'm trying to get the level there that's again got the most touches. Then is in the approximate area. And like I say, it's again a roadmap. You know, if you're long and price is coming up into this area, you may want to think about doing something there. You want to be aware of what's happening. You know you've got a marker there. We can come down a little bit. We've got this here. Again, multiple resistance. Back here, flip to support. So it's a key little area that prices reacted to. We come down a little bit more. Some of this, I'm sure some of you guys are noticing stuff that I'm not paying attention to, or that I'm not too right around here. Now, like I say, some of these are tricky. And if you look at, say, an area like this, this is where I would put this level. Now, that doesn't really, again, satisfy that many people. Because if you look, this is quite a nice little example. Let's look at what makes up the 92.50s level, dollar Swiss. Why do we actually even stick a level anywhere near there? Well, why we do it is for that, and why we do it is for that. And we also do it for that, we do it for that, and we do it finally for that. Now, if you look at it, these are the little bits here that upset people. They're like, well, my level's not perfect. You know, what's going on here and here? Price reacted through it. Our level is drawn visually by the eye. I don't mark this out with numbers, but you'll find the majority of times I'm in, like I said, you come back to that point of the mean. So if we marked out the lowest point, which is this blue box, let's mark it out in a different colour. So the lowest point of that whole zone that I've identified with my eye, if we mark that out, and we mark out the highest point, which is there, look where my green level is. It's bang in the middle. Now, I haven't done that I haven't calculated, I haven't subtracted, you know, 92.33 from 92.63 and, you know, worked out what the mean number is and stuck it there. I've just done it visually. But I put it with my eye in approximately the mean of the zone. But also, I've got 1, 2, 3 perfect touches. So I'm in the mean with the most touches. Those are the strongest levels, and that's where I try to put a lot of my levels. Okay, in the mean with multiple touches. Those are the easiest levels to try and put in play. Okay, so I'm very aware with my eye when I'm drawing these of kind of these price spikes above and below. And the whole mean is quite important. I know I sound like a broken record now, but the whole mean is quite important because when you find people drawing levels, it's these spikes that upset them. They don't like the way price spikes through that level. But it's not a perfect market. So you want to try and pick out the zone which price is definitely reacting to. Again, look at the violence of these reactions. It's quite a nice little sharp. It's quite a sharp spike there, and price stops dead. So we've got some nice moves there. We've also got that concept of time. This one's been going on for quite a while. So my chart at the end of the day for something like dollar Swiss would look pretty much like this. You may have a few more levels in there, but it's going to look very, very similar to this. And this is going to be then my roadmap for going forward. Now, I don't want to get obviously too much into strategy today, but what we can always then use, you'll see, incidentally, look at my weekly chart now, and I didn't do what I told you guys to do at the beginning because it was a bit time consuming. And now look at the mess that I've got on the weekly chart. So if you follow what I said at the beginning, all we would have is 3 red levels. It would look nice and clean, but as it is, it's a bloody mess. So that's why we do that at the beginning. Making sure that we only see the levels on their appropriate time frames. But then what we've got here is we've got our roadmap in play. We know now that dollar Swiss, where it's opening, I would be looking for this significant level down at 89.04s. Maybe we get a gap tonight. We know gaps are a decent thing to trade. Gaps often fill. If we gap down into 89.04s tonight, then I'm all in long. That's going to be a great trade. If we come down into that area with a nice gap, gapping down into prior resistance. We know if we start to make our way up this week that we're going to run into a major barrier at 90.81s. Now remember, our trigger time frame is the hourly. So if we're marking out a level at 90.81, we're still going to always be seeing the price on the hourly time frame. We're going to note that we've already tested it on the hourly time frame. That's not necessarily a problem. We can trade it second time back. My rule is I need an SFP if I'm going to trade it second time back. So I would like to see price breach this first touch and close below it. For me to trade that second touch rather than I always trade first touch blind. Second touch the same way. I want an SFP. But that would be nice. If we got a little SFP there into that level, that would be potentially a decent trade. But you see how they're working as maps. Now, if we shoot back above this area and we start moving up here, then this is going to be a level that we can trade as a long. As we break up through here, come back to this level, this can be an area to try and get long off. I'm really focused on the inverse last on a lot of my levels, because the inverse last is really key to getting the most powerful reactions. So this is what we look for. So there we've got an example of how I would mark up a dollar Swiss chart from basically from start to finish. But what you want to do is just keep going over level after level after chart after chart after chart. Keep marking in levels all the time, and you'll get better and better at doing it. Now, Pedro, I wanted to just get into drawing levels today rather than actually mark out the rules, because the rules there's a lot of them, and there's a lot of things that I specifically look for. But we're going to, like I say, we're going to look at just levels today. Now, what we can do now is pull up another chart. Anyone got any preferences for a chart to draw some levels on? Anyone found a chart that they don't like? A chart they think is particularly difficult? Let's have a test here. Gold, okay. Let's whack gold up. Okay, just also, guys, a side note. I'm sure some of you do know this already, but a side note: when you've drawn your levels in, okay, you've drawn all your levels in. Right click, okay, go to template. Save template and save it. It's really key that you do that, because occasionally this MetaTrader just goes kaput, shuts down, and you lose everything. And there's nothing more frustrating than losing all your levels. I remember this happened to me recently mid-trade. There was a problem with MetaTrader. I closed it, reopened it, everything was gone. All my levels, across all my markets were gone. Now, not only is that a pain in the arse, because you've got to spend ages putting them all back in, but when you're mid-trade, it's pretty stressful. So if you save them as a template, you've always got them. You see what I can do? What I could do now as a cheat is I could right-click, go to template, and I could go to gold. And you'll notice I've got all my levels in play. Well, from the last time I saved it. I've got my map there immediately. So let's get that on the screen. And you can save them as a profile too, yeah. So, but you just don't want to lose them, because they do take a while to do, especially the first time that you come around to doing them. They really can take a while. Now, again, starting out on the weekly time frame, we don't need to go too high, we don't need to go too low, but starting out on the weekly time frame, what have we got around here? First things first, we can see that we're coming into a level at the moment, right around here. Now, where do you draw this thing? Whoops. Where do you exactly draw this? This is an example of a level that looks very weak to me on a weekly chart. I can't get enough data. I can basically see that it's flipped. There's tails there. There's good support, good resistance here. It's one of those levels, though, that I would probably prefer to be looking at exactly how that played out on a daily, because you get, as soon as you flip to the daily, you get a lot more info on exactly where that level should go. So on a weekly chart, to be honest with you, that's the kind of level that I'm not going to even put in. what I would do on this weekly chart is I would mark in, I'd want something here, marking these lows. Now, again, where exactly you draw the level around here is quite difficult. You could draw it at that extreme low, you could draw it at that low there. What I would tend to do here is I would tend to draw this probably around this area. I'd try and get this around about here. The recent low spiked through it. That's a beautiful SFP there, incidentally. The recent low spiked through it. Whoops. But again, you're approximately in the mean, maybe not even quite in the mean there, but I'm very aware that there is a level here as well. That weekly low and these weekly highs here. So this whole area is not clean. What I would probably prefer to do here is mark out these two lows because they're very prominent. And then on the daily time frame, this is probably going to become more relevant, this area here. Now, moving down, I don't see anything in that chart, but we're going to see a lot on the daily for sure. But moving down from there, we're going to have this here. Okay, so we've got a few bar highs, broke out, retested it there. Again, we've got quite a nice little flip point. Okay, now we could come here, couldn't we? Some people probably go there. But remember, we're more focused on what's closest to the right. And if we draw it here, this is the last interaction with the level. So we're always geared towards that right-hand side of the chart. What happened last is most important. These two lows in gold are more important than these little highs back here. You know, I think that's the thinking that's coming into play. I don't think we need to go a lot lower than that. You can for practice. You can go miles down the chart, but I would, for today, we'll keep it fairly close. That's about all I would see on the weekly because they're the big points. They're the obvious points. And although I've refined this level here between resistance and support, you can basically see that level pretty much stands for all of this. It's all I've done. It's that blue box zone. I just refined it where I think the turning point will be. But it's basically covers that zone. So we've covered the two really key areas. What we haven't done is we haven't got anything in here. And I'm sure people will be thinking, hang on, there's something there, approximately, resistance support, there's something there. You can kind of see them already with your eye. But what we're going to do is these are going to be bigger on the daily. And remember, we don't really like the weekly. We're not a massive fan of the weekly time frame because the zones are too wide on the weekly. So we're not going to trade them. We don't want to spend hours marking up a weekly chart. So we're now down to daily. Now's where the fun starts. So, where are we going to pinpoint these levels on the daily time frame? So we're going to start at the top here, and we'll make our way to the downside. Now we're going to have to get something up here. Okay, right in and around this point here. Now, I tend to, and I'll explain this again down here in a second on this lower level. I wanted to show you on the daily. If I've got a double top like this, I tend to draw the level. I know I need it. I need to mark this out. It's not clean. So which one do you pay attention to? I tend to move to the last one, most recent one. So I would draw a level there, which isn't really a level at all, is it? Really, I mean, it's kind of, it marks the double top, but we can't place it in the mean because then it'd be senseless. There'd be no touches or anything. So I tend to just again focus on the most recent price action and put it right at the top. The same thing down here. Although I didn't just do this now on the weekly chart, what I would be doing is now I'm onto the daily, I would be moving this down to the most recent low. Now, as I move it down, look what happens. It lines up a little bit better with this area here, these areas here. Now, you know what I'm going to do here, which is cheeky, okay, with this weekly level? What I'm going to do, and this is cheeky, you see this level? I'm going to bring this down to there. Why am I doing that? Anybody know? Right. I'm just doing it to be cheeky. It was just a trick question. I'm just being cheeky. No, what I'm doing it is because it was resistance last. It's a nice flip, resistance and support last. Now you might be thinking, well, that's a bit ridiculous, man. This is the last major low. The question I put to you is, how often have you last seen a major low hold? Look what happened here. Price broke the last major low. If price gets down here again, it's not going to stop there dead. It's either going to stop before it, in which case it makes no point drawing a level there, or most likely it's going to breach it. Now, if it breaches it, where's it going? It's going to go here. So I don't see the point of drawing the level bang on the last low, because if that stops there, I'll quit trading and become a bus conductor. If that price comes down there, it's either stopping a little bit before it, or it's going past it. And like I say, most likely past it. Why? Because stops build up under the lows. So we really want that. Again, it's in the zone. It's not a far cry from there. It's just geared a little bit towards the resistance last. And actually, I mean, we're getting into the realms of strategy now, but it's quite cheeky when you get this. These kind of levels make for very, very nice trades, because they're kind of like little traps for traders. Because if price tanks, I mean, it's not coming down anytime soon. If price comes down here, see what happens is retail puke it. Okay, they stop out beneath these bar lows. That's where everyone's going to put their stop. The novices always put their stops below swing lows or above swing highs. So the market just likes to take them out. If it takes that out, this is the little turning point. It's quite clearly defined that it's just beneath it. Look up here. Price didn't double top perfectly there. No, it just had to take out the highs. I just had to do it. It has to all the time. In fact, I often say to people, I mean, it's almost in a way, I know how it works and I know how to exploit it, but it almost makes your blood boil why price does this. I mean, I was looking at, in fact, let me just get a blank chart up for a second here. You see, I've got a lot of levels on some of these charts. Let me pull up something here just to show you. Nothing like going off on a tangent. But if you look at this in crude oil, if you look at crude oil, have you noticed how many times when there's a major turning point, does price just like to take out the prior swing highs or swing lows? Look at this. The market bottoms, but it's got to take out that low first. This is why the SFP is such a beautiful, beautiful setup. Why could that not have just double bottomed perfectly? Why could it have not have stopped before it? Hell, why couldn't this rally have started there? That would have been really nice, but no. Couldn't do that. Had to take out the lows first. Look at the inverse of this. Look at this up here. The big calamitous drop. See how it tried to drop before it got there? Oh, but no. It's got to take out the highs first. Got to take out the highs first. And you see the same thing happening time and time and time again. Look even over here as well. Look at all the major swing points. We're not cherry picking them. Look at all of them. Look at this one here. Just pips the highs before the retracement. It's very, very common that you see this kind of thing happening. So, and like I say, that often makes for a nice trap. Going back to our gold chart, if it comes down there, it's very, very likely to pip the lows, just like it did the first time. And so we can try and preempt it by sitting on the bid down at 15-14s if we're aggressive. If we're conservative, we won't do anything. We'll wait for a swing failure pattern. Now, like I say, in crude oil, for example, if I'm going to draw a level there, what I'm going to do is usually I'm going to draw it right at the top, the most recent price action, unless there is a level with the most touches. Now, I actually think on oil, you can draw it down slightly to 1406. Why? Because we've got that high, and that high. We've got three touches. Again, we're in the zone. We're not a mile away, but we've got three touches. Now, that's a very nice example in crude oil. Why? Let me show you. Let's actually really zoom in here. Let me show you this. Where's the zone here? Why do we draw our level here? I'm going to mark out every reason we draw it there. It's that, right? That candle is one of the main reasons we draw it. So is that candle. Pretty much a double top, right? But what else? Those candles. And also that one, right? It's a nice little spike candle. Those are what are making me draw that level in that area. All those candles, I'm seeing all of them with the eye. Now, Let's mark out the highest one. It's that there. That's the highest point of the zone. The absolute top of the crude oil market is the highest point of the zone. What's the lowest point of the zone? It's probably that one, isn't it? And hey presto, look at my level. It's pretty much, not perfectly, but it's pretty much bang in the mean, but it's in the mean where there's the most touches. 1, 2, 3. So that's kind of my secret to drawing these levels, and it's astoundingly accurate. It's astoundingly accurate. I've never quite worked out why, but it is very, very accurate. So look for the mean, look for the most touches in the mean. But I would say on my oil chart, it's going to be 1406. I mean, obviously I'll be aware of what the all-time high is, which is 1480s. But I would draw my actual level at 1406. Okay, let's get back to our gold chart here. So we're in the process of drawing levels here. Unlike the oil chart, we have to draw it at the high because we haven't got a mean point. We haven't got a multiple touch mean point. So we have to draw it there. I'm going to come down a little bit here to this here. Now, here again is something interesting. Can you see that we've got bar highs here, but we've also got a high there, which had a violent reaction off it. Remember, I'm looking at the violence of the reactions. And these here. Right? Now, mark out the high, mark out the low. Where's my level? Bang in the mean. Like I said, I don't mark out the highs and lows, but I'm doing it all with my eye. You know, so I would draw it there at 1803s. Moving down again in gold, what have we got? That there. Incidentally, that's probably where we want to be sitting on the bid coming into this week. Lovely lovely swing points here. Nice violent reactions off. And the level's been going on for some time. Bit of washing there, but don't worry about that too much because look at the recency. Very, very nice here. We've got single candle point high, single candle point high, single candle point low. This is nice. Really, really nice 1663s there in the gold. Let's move it down. Let's go lower. Look at that. Bar lows, recent action, bar lows. Over here, bar lows, bar highs, bar lows, dirty little spike, don't worry about it. It's fine. The majority of the actions can find right at this level. Now, do you know that here, I'm not worrying about the mean. I'm not talking about drawing two purple lines and drawing it in the mean. Why not? Because it's very obvious that it's here, the 1703s. It's just clear as day. Because it's just multiple touches right across the board on that. In fact, we sold 1703, didn't we, on the thread? You know, that was one of the trades we did where we went parabolic on the FOMC news. We shorted it. That was one of the quickest trades I've ever been in, actually. But we sold that there at 1703s because of the prior bar lows over here. You know, we trade the inverse. So we're marking out our levels like this, and we're going to come down again. We're going to keep going lower. Now, you do get to areas that are tricky. And one of these is going to be, I would say, around about here. Do you draw the level at 1668s, these highs and these lows, got a whole lot of mess over here, or do you move it up to 1678s, where you've got highs there, but it's still a bit messy, probably got a little bit more touches. What I would say in that example is I would say, let's let the hourly decide for us. We'll finesse that on the hour. We know we need it somewhere between 78s and 68s. What I would tend to do is I would tend to put a little bit more emphasis on the recent price action. Right? Recently, if we pull it down to 68s, it's a little bit more hardcore. The flip is a lot cleaner at 1668s recently. At 1678s, it's just a single bar high recently. So we've got quite a nicer flip with more touches at 68s, but we're going to have to let the hourly decide where to put that. No, I'm not too worried about that gap back there because that gap's filled now. Once the gap's filled, it's redundant as far as I'm concerned, which it filled, in this area here. So we've kind of got our levels marked up now, above and below market. Now it's time to come down to the hourly, see what's going on. Now look at this. Right, this 1763 is a great level. We've already marked that on the daily. That's very, very nice. Now, again, like I say, I keep being aware and keep saying I don't want to get too much into strategy tonight, but it is a bit part and parcel with levels. What you've got to be aware of with this 1763 is a lot of people always say to me, the most common questions, as you can imagine, is where do I put my stops? Where do I put my stops? And this is partly why it's always really important when you're drawing levels to focus on the zone, right, and what the zone actually means to you. Because if you look at this gold at 1763s, what we've got to be aware of is that most recently again, these are the bar highs. Now, to me, it's undoubtedly the case, looking at the level, that 1763 is a better, bigger level, more likely to get a bid than this one here. It's just a bit, it's way clearer. It's just more likely to get a bid. But am I really wrong if price squeezes down here? No. So I know that I've got to have a stop below that. I know that I've got to have a stop there because I'm always thinking, where am I wrong? I'm wrong if we breach this zone. So actually, in this example, if I get long at 1763s, my stop will be well placed here. I don't believe this last thrust candle, that 1755s, about an $8 stop, which is pretty wide, but in gold, it's not. It's hardly anything. It's about 1/3 of the day's ATR. But that serves me quite nicely because giving it a little bit of room, not too much room. We don't want to be ridiculous. We're giving it a little bit of room, but we're letting it test the lower extremity of the zone here. And one thing I have learned is that price does often like to come back and test the last area of highs. So you're going to have the big level, but you're going to have the last area of highs. We need to mark them out. That's why I would put a level there, and a lot of people wouldn't, because a lot of people would say, well, I don't need a level there as well. Bloody hell, I've got so many levels here. But you've got to be aware of that 1759s, and I would put a level there. This thinking came into play in silver last week, because I don't know if any of you guys got silver, but I missed it, and I missed it through actually not paying attention, to be perfectly frank. But look at this level here in silver. If we zoom out on the silver chart, where is the level with the most touches? Let's have a look. The level with the most touches is there, right around there. That's where I have my level at 3440s. Okay, touch here, touch there, touch there. This looked like the area that had the most touches, and again, this particular level was more or less in the mean. More or less in the mean. But if you think about it, where was the extremity of this area? The extremity of the area was there. This high and that high there. So you have the level with the most touches, but when price broke out, you also had this was the last high, and that's where price rallied off. You see how price is really, really affected by what happens recently. Although this was a massive area back here, suddenly on the most recent breakout, price was really respecting this area, these bar highs, and that therefore was the last area that got hit. And on a side note, why do you reckon price only extended back to here and probably didn't come back? Well, it didn't come back to the bigger area. Any reasons why that might be the case? Not just because it's the most recent bar highs, that's part of it, but what's actually going on behind the scenes here? Okay, we've broken out of a massive daily range. broken out a huge daily range. Now, when we break out of a massive daily range, what happens? Traders get excited. Shorts are in a whole world of trouble, and longs are getting very excited on the breakout. They've seen this massive parabolic candle go through here. They've seen it breaking out the daily range. They're all over it. They want to get in. Okay? Now, if you think about it, the breakout traders see that massive candle and they're desperate to get in. Desperate to get in. Now, when you're desperate to get in, think about it. When you're undisciplined and you're desperate to get in, are you patient enough to wait for price to come back to the best level? No, you're not. You're gonna get in at the first possible point you can. So you often find on violent breaks, price retraces to the range extremes, even if there's less touches than below, if that makes sense. Don't know if that makes sense. Again, we're sort of blurring the lines here between where to put the level and strategy. In that gold, really you wanted two levels, one at 34.40, one at 34.50, because there are two levels there, but it gets into the realm of strategy that you probably want to bid at 34.50 for that, rather than this one, because although undoubtedly to me, 34.40 is a bigger level, it's had more touches, price has spent a lot longer doing stuff around that level, it's the desperation that's going to get buyers in the 50s. They're desperate here. We've just gone parabolic out of a massive daily range, they just want to sit on the bid and get long. And the shorts, who are in the shit as well, just want to get out of the way. Now, actually, FX, that's an interesting point. Would you split your order between two levels? You can do. I'm not a fan of doing that, but that's just personal preference. I quite like to just whack my size at one order, at one level. I would say, it's somewhat contradictory now, I would say the majority of the pros that I've traded with do split their orders. They do tend to. It's personal preference, but I know a lot of the guys that I traded with would have been probably bidding for some at 34.50, some at 34.39s, with a stop for both, maybe like a little way beneath here. Give it a little bit of room, but again, you don't want to give it a ridiculous amount of room. Put it stop at a logical turning point, but they would try and scale in a little bit there. I know that for a fact. So yeah, you can do. I've never been a real fan of that, but it is logical. So again, with these levels, what you want to do is you want to pull up your charts and let me just close silver for a second. Go back to our gold chart. So we've done our weeklies, we've done our dailies. We're now coming down to our hourlies. And again, process starts again. Now, on our hourly charts, got to have this in here, right? That there. Got to have that in. Nice, decent support. Want to have that marked in. We also probably want to have that in there. Is this a huge level? Resistance, a little bit of support. Is that a massive level? No. It's not a great level. It's not a huge level, but it's a roadmap. It's a marker. We need to be aware of it. It's come down a bit. We've got a lot in gold. We've got this here. Where do we put it? We put it right down at the swing low. We put the level there. Where exactly do we kind of draw this level? To me, again, where I'm going to draw it, it's usually going to be the mean. Magic word again. What's the mean of this area? Again, mark it out. I know I'm doing this an awful lot, but it's really important. That. Always thinking about why are we even drawing a level here? That. That spike through it. That there. And that there. These are all the points that are making us draw the level here. Okay? What's the lowest point? What's the lowest arrow? It's this one. Put it in a different colour. Lowest point's that one. What's the highest point? The mean with the most touches is what we ideally want, if we can get it. Here we've got two candle touches, two lows there, very close right the way back here. But we're pretty much in the mean again. And like I say, it doesn't appeal to everyone because some people say, well, just stick the price, stick the level at the low. But it doesn't seem to work like that. The levels don't seem to tend to be as accurate if you do that. So the key to identifying these levels is look at why you're actually drawing a level in there. What highs and lows constitute that level? And then try and place your level in the mean of that zone at an area where there's the most reaction, the most touches in the mean of the zone. And be aware that it is harder on some markets. If I want to mark up dollar Swiss, it takes me 5 minutes. If I want to mark up sterling dollar, it takes me 25 minutes. Pound dollar's hard. Dollar Canadian, Jesus, it's impossible. Nothing's impossible. But dollar CAD's very difficult. You know, levels are tricky on that thing. Dollar yen, easier lately. I use the hourly level for entries. But I'm always trying to appraise myself of what's going on. I mean, as an example, let's look at, if I delete my dollar Swiss chart now. Where's Euro Swiss? I am looking, where's my dollar Swiss gone? File. No, that's excellent. Spend all the afternoon drawing up a chart and just delete it. Brilliant. With dollar Swiss, like I say, I'm looking for this level tonight, 89.04s. Because it's a beautiful level on the daily time frame. I don't need to come down to the hourly. I'm not looking for any price action here. I just want to buy it blind. If we gap into it, more the better. You know, so I want to buy 89.04s. I think it's really, really nice level here. And, you know, if we do come down to the hourly, this is a little trick I do as well, come down to the hourly and actually scroll back and see what that level looked like on the hourly. Look at that. It's very nice. Very, very nice here. You know, the 89.04s, two bar highs there. It's pretty clean. People that are looking there at that area, where might their stops be as price comes down? Probably below this. It's 3 bar lows. So it comes back to that trap again. A lot of people stop out under here, stop out right into this. Have you ever stopped out of a market and then it's reversed? The minute you stopped out, it's reversed. How many people has that happened to? You stop out, literally it goes 5 pips past your stop and then it goes parabolic the way you thought it was going to go. Happens to everybody, right? Right, okay. If it happens to you, check the chart very carefully, and there's a very, very high likelihood this has happened to you. You've stopped out into an area of previous highs a little way below. Because I always look back at when I stop out. It's happened to me occasionally. And when it happens to me, it's nearly always this little phenomenon here. That you've placed it beneath a low, the market's taken you out, and it's gone straight. It's not, you know, it's not just the market out to get you. The market doesn't care who you are. It doesn't know who you are. The market trades off of value areas all the time. This is why SFPs, if you can do one thing to improve your trading, and I know this is not the subject of tonight's webinar, but if you can do one thing to improve your trading, get good at levels, but look at these SFPs. SFPs at levels are killers as well. Absolute killers. The market loves them. Absolutely loves them. Can't tell you how much it loves them. Look at this level in dollar Swiss here. At a really nice level of support, prior support, all the way down. The extremes of the range, look at all this support down here. The extremes of the range are there. And does the market give you a break? No, it doesn't. You try and buy the support, stop beneath the lows, out you come, market goes vertical. Where does the market go vertical to? Yeah, you guessed it. Prior bar highs. Bar lows, bar lows, bar highs. Straight up there and turns again. Comes all the way down, and yep, it nabs you again. Just takes out the lows, closes above, straight up to the second area. Loves doing this. This is why I put a lot of emphasis on the close. Once you close through this area, it's likely to go. Right? It closes through it here, doesn't look back. But it's these, it's these little spikes where it doesn't close, it just takes you out on the run, then comes back. SFP is a killer pattern, absolute killer pattern. But look at it at good, strong levels as well, because then it really comes into its own. So like I say, in dollar Swiss tonight, that's going to be a level that I'm looking at, the 89.04s. See if price can get down. Now, I would prefer it on a gap, because I know that then we've got the confluence of the gap fill, which would make it nice. But I do think it's a decent level. If we return tomorrow up towards the 9080s, and we eye up this area again, it's a formidable level on the daily. It's huge, absolutely huge on the daily time frame, that 9080s. About as big as they come. But we've already tested it on the hourly, we've already been back there. So what would I like now? I'd like the market to come take out this little prior bar high. Because the shorts that are in the trend, one of the things, and I'm really going off on a tangent here, but one of the things that one of the things that everyone is taught to do is put their stops above highs when they're short, swing highs. Why? What you've got to think about in the market is, why are they told this? Why are all the newbies told to do that? The reason they're told to do it is because it's trend definition, isn't it? If you're short and you're following the trend, you're going to be a good little trend trader, and you're going to put your stops above swing highs. Why? Because when the price breaks a swing high, it's in an uptrend now. Higher highs equals uptrend. But a lot of the time it doesn't. Higher highs equals you getting stopped out and then the trend continuing to the downside. Because it's such an obvious area for stop placement. Stop placement moves the market. It's one of the most key things to learn. Where does everyone put their stops? And you don't want to be with them. You want to be taking advantage of them. Okay, so have we got any questions related to these levels? I appreciate we've gone from levels to strategy to SFPs, but hopefully you've got a good insight into kind of what we do with levels. And what you can now, use Twitter as well, because I'll tweet levels constantly, and you can, it's one of the main things I tweet, and you can check them out and see, right, have I got a level there? Have I not got a level? A lot of people ask me about the 89.04s. That's one of the questions I got loads on Friday. What's going on at 89.04 in dollar Swiss? Why have you got a level there? But now you'll know it's because a little bit of a gearing towards prior resistance. Good question, Hunter. How did I get the target level last week in silver? Back on that silver chart. Right, 34.89s. 34.89s. It was the previous congestion highs. Previous resistance highs, spike high there, candle low, several candle lows in this area. I thought that was quite a good area to take some profits on the trade. I didn't necessarily think it was going to stop there, but look what happened on the 34.89s. It banged straight into that, and then it had a really violent reaction. Then it went through it. This is what I'm saying about your levels. If you look at that on a daily chart, you think to yourself, well, that was a very good level, was it? Price split straight through it. But if you look on your hourlies, which is your trigger time frame, you'll find if you're drawing your levels in the right place, price will respect them a lot of the time. This got literally, what was the drawdown? 9 tick drawdown. And then we pulled back 29 ticks off it. That's what you want to be seeing. 80% of your levels, you want to see that. If you don't see it, you're definitely drawing them wrong, I'm telling you. But one of the hardest things about, the other thing I'd say is that I had quite a few students that started drawing these levels on. And it's like, suddenly they're like, wow, this is the holy grail. Levels are the best thing ever. And you get very excited about them. But they're not the best thing ever, because while they're brilliant, while they're excellent, they're also very difficult, because as a trader, you know that the price will react to a level. Okay? It's very high probability. In terms of gauging where price is going to react, I do think levels are the best thing ever. But what you've got to work out as a trader is, how far is it going to react? All right, and that's when trading gets difficult. That's what we're going to look at in the next webinar. We're going to look at what levels do we actually trade. How far is price going to bounce off them? in general, the stronger the level, and think about those points we said at the beginning, the more violent the reactions, the more time the price is spent as a level, okay, and the bigger the number of touches. The more you get of that, the more you get a kind of trampoline factor. So the stronger the level, the more likely price is to bounce off of it, and bounce off it quite violently. But this is what that's half the battle. Identifying the levels and the turning points is only half of it. The other half is how far is this thing going to go, and that's when the game really starts to get tricky. I would call a level washed when historically price has spent more time trading through it than off of it. So if price is constantly washing my levels, then I would say that they're being washed and that they're not great levels anymore to me. And it will happen from time to time that the levels, that your levels will just get a little bit disrespected. I guess you get a feeling for them over time as to exactly what's going on. Is price respecting your levels, or is it ignoring your levels? That's kind of, if price is trading in and out of it and really, massively, completely ignoring it, and it's being washed. I don't know if that makes, it's probably not the clearest answer in the world. But for example, I wouldn't say this 34.89 in silver has been washed. Although we traded through it a little bit, that's still clean, that's still fine. Now, if we shot up through it 20 pips and shot down through it 20 pips and shot up through it 40 pips and shot down through it 50 pips, and it just zigzagged massively through it, then I'd be thinking, well, hang on a minute, price doesn't seem to be too conscious of my 89s level. But now I'm looking at it thinking, yeah, okay, we squeezed it a little bit, fine, but basically that, price liked that. Price told me I'd done a good thing by drawing it there. Could I possibly rank the order of pairs that are easier than others? Well, I think dollar Swiss is one of the easiest to draw levels on for a start. Let's think off the top of my head. Some of the equity pairs, DAX, like the DAX, the FTSE, maybe not the FTSE, the DAX is quite fairly easy. Some of the levels tend to stand out. Dollar yen is not too bad recently. I think it's probably easier to say which markets are tricky. I always find dollar CAD tricky, and I always find cable quite tricky as well to draw levels on. I mean, once you experienced at it, nothing's too hard. But there are some that, for me, it's not so much they're tricky. You spend longer, and I always dread USD CAD and cable a little bit because I know that I'm going to be, spending a little bit longer on the charts. I try not to do a whole lot with USD CAD. I mean, I touch trade everything, but I was saying to the guys in the trading room, I'm probably going to leave dollar CAD. I'm going to probably just get rid of it. My strike rate's not good in it, and it's a very difficult market. It's very mean reverting, which is not good for someone that's trying to capture big swings, because it'll make a big swing and then it'll come back very, very violently. So that's one of the things I don't like about USD CAD. However, it's beautiful for SFPs. I mean, beautiful. So if you're a big fan of these SFPs, you want to keep watching USD Canadian. It's actually the market I discovered the SFP on. Rob, I'm not sure I understand your question. Would a level become washed out if an indicator was contrary? I'm not totally sure I got that. Yeah. Well, I mean, with me, that's all. Yeah, if the indicators showing divergence, that's something that that I look at, especially at kind of triple tops, triple bottoms. If there's kind of divergence from an indicator like MACD, I mean, I look at the MACD, just at triple tops, triple bottoms, then I'll be a little bit concerned. But it's always, for me, it's all about the SFPs. If I get that SFP trigger with divergence, I mean, it's a no-brainer to give it a whack. But not so much the indicators. I never have an indicator on my chart unless price is making a triple top, triple bottom after an extensive trend. And I might look and see if we've got some divergence, or maybe not triple top, triple bottom, but slightly higher highs. In fact, why don't I just, rather than talking, actually show you an example? I'm trying to think of the last divergence-based trade I did. I think it was in DuPont, actually. Yeah, this here. You see, we had basically a massive trend up, and we got, this isn't really a triple top, but we had price making a high, tanking, just breaking that high, and then tanking again. Now, interestingly enough, look at this. Ooh, what's that? I wonder. SFP breaks the highs, closes below, bang, there comes the sell-off. Then we make the high again, and we stay up here. Now, that's the kind of area that I would quite like to look for divergence at, because it looks like price is running out of steam. On the way up there, it's a very, very clean trend. And now it sort of looks like it's starting to struggle. So that's when I would stick on that MACD. And when I stick on the MACD there, you get that, and then you think, okay, time to look for a short there, and you see that occur, and then finally you get the bearish outside, and you suddenly think, okay, time to get short here. Okay, but I don't want to get, like I said, I don't want to get too much into this because there's a lot that I do. I mean, I use a bit of divergence, I use ATR, I use a lot of these things. You're best off reading the thread. But what we wanted to look at today, like I say, is levels, which I think we've done. If any of you guys get any questions afterwards, you suddenly think of something, send me an email about it, and we can go over it. But like I say, mark up your charts. Go ahead, mark them up before the open, and look this week at how price reacts. Look this week at how price reacts to your levels. So the main rule that you want to try and take away from today, I'm going to write down. Okay, so the number one kind of rule is identify zone. This is what I do with my eye. Identify the zone. Then place the level in the mean with preferably the most touches. Okay, so the mean of that zone with the most touches. And at this point, you're going to have two kind of little additional focuses, which is recent PA. You're going to be slightly geared towards the recent price action. You're also going to be slightly geared towards the inverse. So where are we? So it's identify the zone is the first step. Second step is find the level in that zone, which is the mean with the most touches. Try and gear your level in terms of this kind of area here is the finessing. I don't know if I've spelled that right. This is the finessing. Recent PA and the inverse. This is where you really bang in and hone in on exactly where that thing is. Where was the level on that? On DuPont. I don't know if it's going to let me go back that far. There was a level. I believe there's a level on the hourly. Because when I've seen the price action on the daily, I'm waiting for the price to retrace. You're looking for a price on the to retrace on the hourly to sell. As soon as you get a bearish outside bar, you want to look for the price to retrace, which is as it pushes up. I don't think gaps make it that much more difficult to trade levels, to be honest. You just have to factor them in. When you see a gap, you've got a likelihood that the price is going to gravitate towards that fill area. That's one of the things that I'm always conscious of. The inverse, for those of you that are wondering, is one of the foundations again to my level thinking, which is that when price breaks a level, we want to act at the level where the other side of the market dominated last. So, as an example of that, just again looking at dollar Swiss last week, when price broke the support, we're very keen to get in on the risk, for it to potentially act as resistance. I don't like going the same way as the group before me unless I've got an SFP. So, for example, if we've hit support once, twice, 3 times, there's no way I'm buying it for the fourth unless we've got a stunning SFP. And usually I want an SFP second and third. By the fourth, it's going to have to be something pretty damn amazing to get me in long, buying a support level after it's been hit the 4th time. Why? Because that's where the stops go. You try and think on all your trades where a stop's going to be. They're always going to be above, below swing points. And the more swing points in a certain area, the more likely you are to get stops. The market will love to take the stops. Silver last week, I mean, a lot of people have been astounded by silver and saying, wow, look at that move. It's gone absolutely vertical. Look what silver did before it went out. No surprises. There was the range. Beautiful daily range. And look what silver did. Why did it react so violently? Because it's completely trapped everybody. There was a beautiful level in that silver, and I still say it's there as well. Right here. Bar highs, bar lows, bar highs, bar lows. Nice little level in that whole zone. Interestingly enough, I would call that the mean of the zone. Why would I call it the mean? There's 2 points there that massively screw up our level. What are they? They are this. They are that. There. I bet you if you draw a level at both, mine's going to be in the mean again. There we go. Look at that. It's nearly always the same thing with all my trades. That my levels just tend to be in the mean with the most touches. Got a lot of touches here. It's all done by the eye. But you see the eyes marked out, the highs and lows, the messy parts that people don't like. You mark them out and you whack it in the mean. But with the confluence of multiple touches. Okay. Right, I'll have to just answer these questions. And then that might be about as much as we can do today. Let me have a look. Do we do last week's chart, then day chart, then hour chart? How many weeks back? Well, I've got a standard rule, and this sounds a bit ridiculous because it's going to be different for everybody. I've got a standard rule that on the weekly chart, I zoom out once until basically, usually zoom out once until I can't actually see the candles anymore. You see here that I can basically just about see the candles. You see if I zoom out once, I can't see them quite clearly now. That's as far as I go on all time frames. Now, I know the reason that sounds ridiculous is because it's going to depend on the width of your monitor. But that's just a standard little rule I have. And it means on the weekly, I get basically about 10 years of data. On a daily chart, it gives me approximately about 3 years of data. And on an hourly chart, it tends to give me approximately 6 weeks of data. And that just enables me to plot bigger levels, the more strikingly obvious ones. Otherwise, if you don't zoom out far enough, you tend to miss stuff. All right, let me show you something. You'll like this. Speaking of the trap today, the lows in silver. Here are the lows. You see all these lows? Lows, 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 lows. Bang. There's the stop run. Takes out all the stops, then reverses, right? Look at that low. The price puts in there. And then let's zoom out. You see this? Not perfect. Most perfect example ever. But you see how price tends to gravitate towards prior bar highs on the stop run. There's no way price after that many touches is not going to bust through there. It's very, very unlikely because all the stops are there, which means that's where all the liquidity is for the pros. I don't look at volume, Rob. Some people do. I don't look at volume personally. It's not. You obviously haven't got any volume in forex, so I don't look at that. You can look at it in stock equities, in equity index futures, bonds, etc. If you've got the volume up there. Row, how price approaches a level is quite important to me. But if it goes vertical very, very sharply, let's say, into a prior support level, I'm all over it. I don't care how hard price goes. I don't care how much I fade a momentum candle if I've got a good level that was the inverse last. I don't like, one thing you want to try and get your head around is that momentum doesn't indicate a force. Just because you get a massive green candle does not by any chance mean the next one's going to be green or it's going to keep going. So, to me, the hallmark for me is how good is the level that the price is coming into. It's a solid brick wall of prior support and we're rallying at, 90 pips a second into it. I'll still stand in front of it. It's a solid level. I faded Jap intervention using that same technique. Price was going absolutely parabolic. I think I went over this in the free webinars. Here, this was one of the greatest fades ever done. Hang on a minute, wasn't this one? I'll get it right in a minute. That one there. This here, price was just going vertical. You bang it short. I got short at 79.99. Look at 99s for a second and you might think, well, hang on a minute, that wasn't very accurate. Price splits right through there. Zoom in. That was the reaction I caught. I sold the exact high. Actually, that's a lie. I went 1 pip offside and they got like a 50 pip reaction. Well, in fact, I got 50 pips out of it. It actually went about 75 pips right off that high, the initial pullback. Now, why there? Why there? Look left. Solid brick wall of support last. The inverse last. One thing change your trading around, it will be selling the inverse last. Buying, selling what was last support, buying what was last resistance. That was a lovely trade, actually. So, yeah, you're not scared. You're seeing price do that. But, you can step in front of it, in my opinion, if the level's good enough. Can I clarify the circumstance in which I would move a level drawn on the daily chart when I zoom into an H1? Generally, what I would do is I don't really move my daily levels around that much. I'll stick a daily level on the charts and I'll keep it there. I won't really refine it. I might put more levels on an hourly chart, but I won't really refine it that much. And Tommy, are you saying the D1 bias with the pin, is that in silver, right? A bit behind the curve here. That's in silver. Yes. Yeah, well, when you see that, what you've got to be looking at there is, you try to put yourself in the head of everyone else in the market, right? So they're going to be short down here. So you've got all the longs that puke that down here. they buy the multiple support, they puke the low as it tanks. And then you're obviously going to get all the shorts that have steamed into the market there with their stop sells, because that's what a lot of people do. They straddle, don't they? Straddle the highs, straddle the lows with stop sell orders. So now you've got the buyers washed out and you've got the short sellers in there. Now when it closes like that, there's going to be a lot of sellers down there that aren't happy at all. They're going to be trapped offside. Now usually what they're going to start to do, they'll start to bail on them, especially as it forms a pin. They'll probably start bailing as it moves higher. But you can bet there's a fair few of them that are on the other side of the range, because this is what is regularly taught on a break. I mean, again, basic 101 breakout strategy. You know, sell the break down here, stop above the other high of the range. So you often find that when you get side out and closes back in the range, it's usually going to go and do the other side. So when we get a bias to get in there, we're looking for that to at least trade out. You know, just take out the highs of the range or take out the other side of the range. And look, when it does, it stalls as well. It's a beautiful thing. You know, it goes right up there, takes the highs of the range, and then it just stalls for a day while the market participants work out what to do. But this was interesting again, because on this daily chart, we've got the pin for bias, but we enter off the hourly. And if you remember what we did here, actually, I don't know if I tweeted this or not. I think I did. What we were doing here, I think I did tweet this. What we were doing here is we were looking to get in off this. Okay, so we had the pin on the daily for bias, but we're down to the H1. The market's got to tip its hand on the H1. And again, you know, it's not rocket science, it's just good levels on the hourly. If this was a daily chart, we'd be all over this for a level. 1, 2, 3. We don't even need to be in the mean here because we've got multiple bar touches right in the same area. You know, price breaks, bang, retest it. Where's the level above that? Anyone see the level above that? It's here, isn't it? Up here. Bar highs, lows, highs here. Right in this kind of zone here. Note how it's probably in the mean again, because this level doesn't quite touch it. Right? But neither does this level up here, and that level there. Kind of again towards the mean of the zone with the most touches. So price goes vertical to the tops of the range. Right, we take some profits. We're going to sit on the bid again at 3400s. There we go. Straight back to 3400s and off we go. You can job these levels really nicely, but they just got to be good ones. They've got to be nice, solid ones. And if you've got, you've got a bias as well, you can trade them. You can trade them effectively. Like I say, in that silver, we had a bias all the way. It's going to go up to the top of the range there because it's just a very, very big trap down there. And the market will get carried higher on the blood of others. It's like one of the nicest, sharpest patterns you often get sharpest moves you often get is pattern failure, right? So if you get like a big head and shoulders, and price craters through the neckline, and then it fails and it comes back in, there's going to be loads of people that are screwed. They're all expecting market to tank, but it breaks the neckline. So there'll be loads of people on the back foot, and you often get these really violent reactions as everyone just basically has to pay up and get out of the market. So I like to look at that in my own trading. I like to think, what's everybody else thinking here? What are they thinking? What are they doing? And just like I say, most importantly, where are they going to have their stops? It's all about the stops. Okay, so hopefully you guys have found that useful. Like I say, sorry we did go off on a little bit of a tangent from time to time, but we've gone over the levels. If anyone's got any questions on levels, let me know. But I presume that what most of you now want to do going forward is look at exactly the setup and the rules for how we trade these. And we'll go over some of this in the free webinar. But the next webinar I do, I'm going to give you, when I say a list, I mean clearly defined rules. If X happens, do Y. Exactly what to do, pinpoint, no room for doubt. But I wanted to do the two separately because defining levels is really, really key. Once you define them, you go on to the next step, which is how do I trade these things? So the task this week, you've got a whole month till the next one. The task for the next month is start drawing your levels in and keep practicing them and get to the stage where the price is reacting off them. It's not going to react off every single one, but you want to see price doing something at the majority of your levels. Keep working on it till it does, because you should be able to get that. Maybe not pit perfect, but sometimes I regularly on a lot of my levels, price draws down 10, 12, 13 pips sometimes before it then reacts off it violently. Sometimes it will be the exact turning point. But if price starts blitzing through your levels 40 ticks before it has any kind of reaction, you need to finesse it better. And if anyone has any questions, do just email them to me. I'm always here. Like I say, you will get a bit of a delay lately with getting a response from me via email. Well, you will get one at some point. It just won't be the speediest response ever. A few days, maybe. There we go. RJ making me look good there. Sent an email 10 days back and she still hasn't got a response. Eve, rather. I'm clearing my backlog this week. It's my task for this week, so everybody will get a response this week. I do use FX Pro for my charting, and trend lines are a difficult one. I tell you what, we'll do trend lines in the free webinar next week. We'll talk about trend lines. Remind me about that, and we'll go over it in detail. I haven't really got time now. But I don't like them a lot, but there are times when I'll use them. We'll go over those next. We'll go over those in the free one. Does the closing time matter? That's difficult, actually, to answer, Hugh, because I haven't got a frame of reference, because I've always used FX Pro. So I don't know all different. I couldn't compare to another broker. I'd like to say no. But there's always that question. People say, well, you trade off UK time, US time, the bar closes, does it make any difference? I'm going off UK, with FX Pro, and I'm cushy with it. Everything's fine, but I don't know. I think FX Pro. No, I think FX Pro's 10 because it's European. I think it's 10. I think it's 10 p.m. that the candle rolls on FX Pro. But it looks like midnight on the charts. Is what I'm saying. Because if you hover over it, it will say midnight, but it's actually 10 p.m. Do you know what? I love MetaTrader. I hate my spread bet brokers charts. I just find Java really, really slow, and looking at multiple charts at the same time is not easy to do. And of the charting platforms out there, I really like FX Pro, MetaTrader a lot. When I left, we used to use something called CQG at Futex, which is like really professional. One of the best programs out there, and you get the prices all taken directly from the exchange. It's very, very good. A lot of banks, top firms use it, but it's about 500 quid a month. And when I left Futex, I still had access to CQG and was still using it from home, and I still tended to use MetaTrader, even though MetaTrader's free and I had access to a CQG platform for 500 quid. I still tended to use MetaTrader. I just like it a lot. It runs smoothly, runs good on my machine. CQG was a little bit slower. And it's reliable. Occasionally you're going to get a couple of pip differences, but when you're a swing trader, it doesn't make too much difference in the great scheme of things. I know some people that say like, oh, I need it's not good enough. I need an absolute spot on, accurate feed. But they usually tend to be people that are scalping like tick charts of the equity indices where every tick counts. But as a swing trader, I've never had a problem